Imagine a company reports earnings that beat Wall Street's expectations, and then watches its stock plunge nearly 12% in a single session. That's precisely what happened to Amplitude back in early May of this year, when the digital analytics firm posted Q1 CY2026 results that surpassed analyst estimates, only to see investors send shares tumbling 11.8%. It's a classic case of buy the rumor, sell the news, and it raises a sharp question for anyone with money in the market right now. When two tech companies show very different revenue trajectories, what does that actually tell you about where each business is headed? Today, on the 16th of July, 2026, we're putting Amplitude and Agilysys side by side, two Nasdaq-listed technology businesses serving completely different markets, to find out what their revenue trends genuinely reveal for investors. Before we dive into numbers, it's worth being clear about what each of these businesses actually does, because context shapes how you read a revenue line. Amplitude, trading under the ticker AMPL, is a product intelligence and digital analytics platform. Its software helps companies, typically software-as-a-service businesses, consumer apps, and e-commerce platforms, understand how users behave inside their products. Think of it as the engine that tells a tech team which features drive retention and which ones send users straight to the delete button. Agilysys, on the other hand, trades as Agys and operates in an entirely different arena, hospitality technology. It provides property management systems, point-of-sale software, and inventory management tools to hotels, resorts, casinos, and food service operations. These are two companies with almost nothing in common in terms of end markets, yet both sit in the broader enterprise software space. And that's exactly why comparing their revenue trends is so instructive for investors trying to understand where B2B tech spending is flowing in 2026. As of this week, Amplitude's earnings story is still fresh in the market's memory. The Q1 CY2026 beat, reported in early May, demonstrated that demand for product analytics tooling remains alive, even in a cautious enterprise spending environment. However, that post-earnings drop of 11.8% tells a more nuanced story. Investors looked past the headline beat and focused instead on guidance, growth rate deceleration, or valuation concerns. When a stock falls on good news, the market is essentially saying it expected better, or is worried about what comes next. Agilysys, meanwhile, has been steadily building its reputation as a more defensive but growing tech play. The hospitality sector rebounded aggressively from the pandemic years, and Agilysys has been a direct beneficiary, embedding its software more deeply into hotel and casino operations at a time when those venues are investing heavily in digital transformation. The Motley Fool's comparison piece, published just 2 days ago on the 14th of July, specifically highlighted the diverging revenue trajectories of the two firms, a signal that institutional analysts are paying close attention to this contrast right now. Revenue trend analysis is about far more than a single quarter's top-line figure. What matters is the direction, consistency, and quality of growth over multiple periods. For Amplitude, the concern in the current market is what analysts call growth rate compression. The company may still be growing, but if that growth is slowing quarter on quarter, investors applying a high valuation multiple will reprice sharply. This is especially acute for software businesses priced on future earnings potential rather than current profitability. The 11.8% share price drop following a beat suggests the market had already priced in a stronger forward trajectory than management delivered. For Agilysys, the revenue story is arguably more straightforward and arguably more reassuring for value-conscious investors. Hospitality tech spend is sticky. Once a major hotel chain or casino resort integrates property management software into its operations, switching costs are enormous. That stickiness tends to translate into highly predictable recurring revenue, which is something institutional investors prize enormously in uncertain macro conditions. A company with reliable, contract-driven revenue can command a premium multiple even if its absolute growth rate appears modest. Here is the central tension every investor must reckon with when comparing Amplitude and Agilysys. Are you optimizing for high growth potential with higher volatility, or for durable, compounding cash flows with lower upside? Amplitude sits firmly in the high-growth, higher-risk camp. Its addressable market, product analytics, experimentation platforms, and behavioral data tooling, is genuinely large and expanding. Every software company in the world, in theory, needs to understand how its users behave. But the competitive landscape is fierce. Rivals range from Google Analytics to Mixpanel to Heap, and even large platform vendors like Salesforce and Adobe are encroaching on this space. Pricing pressure is real. Agilysys, by contrast, operates in a more specialized niche with fewer serious competitors at the enterprise hospitality level. Its customers are not startups experimenting with analytics tools. They are large, established venues with significant operational dependencies on Agilysys software. That creates a fundamentally different risk profile. Neither approach is wrong. They simply suit different investor temperaments and portfolio strategies. The broader context for both businesses is a 2026 enterprise software environment shaped by two converging forces: artificial intelligence integration and cautious IT budget cycles. Amplitude has been actively building AI-powered features into its analytics platform, automated insight generation, predictive retention modeling, and natural language querying of product data. These are genuine differentiators, but they also require continued investment, which can weigh on near-term profitability metrics. Agilysys has similarly been embedding AI capabilities into its hospitality platform, particularly around dynamic pricing tools and guest experience personalization. Crucially, the hospitality industry's post-pandemic recovery has matured into a more selective phase where operators are upgrading legacy systems rather than simply reopening. This upgrade cycle is a direct tailwind for Agilysys' revenue visibility, as legacy to modern migrations tend to be multi-year contracts with significant implementation services attached. The Motley Fool's analysis on July 14 drew attention specifically to how these differing growth catalysts are reflected in each company's revenue trend lines, and it's a distinction that appears to be gaining traction among professional investors. Looking ahead based on current evidence, Amplitude faces a pivotal few quarters. The post-earnings share price drop in May suggests the market wants to see either a re-acceleration in revenue growth or a credible path to operating profitability, ideally both. If the company can demonstrate that its AI-powered product offerings are driving net new customer acquisition and expanding existing accounts, the growth narrative can be rebuilt. If instead revenue growth continues to moderate whilst competition intensifies, the valuation compression could deepen further. For Agilysys, the near-term outlook appears more settled. The hospitality technology upgrade cycle shows no signs of reversing. International expansion, particularly into European and Asian resort markets, offers incremental revenue channels, and the company's recurring revenue base provides a floor that growth-stage software businesses simply cannot match. Analysts tracking this space will be watching closely for any guidance updates in the next earnings season, which for many mid-cap tech firms falls in late July and August. Investors comparing the two should ask themselves a single, simple question: at current valuations, which growth story am I being adequately compensated to own? So what is the takeaway from laying Amplitude and Agilysys side by side? Revenue trends, when read properly, tell you far more than just whether a company is growing. They reveal the durability of the business model, the pricing power of the product, and the conviction, or lack thereof, of the customer base. Amplitude's revenue story is one of genuine potential operating in a genuinely competitive arena, where execution must be flawless to justify the premium the market has historically placed on the stock. A beat that still triggers an 11.8% share price decline is the market demanding higher standards, not rewarding mediocrity. Agilysys' story is quieter, less dramatic, but in many ways more compelling for investors who value compounding over excitement. Its revenue trends suggest a business deepening its moat in a specialized vertical, with sticky customers and a growing international footprint. Neither company is a guaranteed winner, no investment ever is. But understanding the character of each revenue stream, not just the headline growth percentage, is what separates informed investors from those who simply react to headlines. Do your own due diligence, compare valuations carefully, and remember that in tech investing, the quality of revenue matters just as much as the quantity.